Hi, I'm Candis Fitch, Portfolio Manager at IAIC. Welcome to another episode of In Focus. Today, I'm joined by fellow Portfolio Manager Nick Leach, who is responsible for our income producing section of portfolios. Welcome, Nick.
Hi, Candice.
So last time we chatted, we talked about bonds. There was a lot of excitement going on. Can you give us a little bit of an update of what bond market returns look like so far this year?
Yeah, so far this year, for 7 months, we've seen various sectors of the bond market providing various types of returns, and none of which have been very exciting. So looking at the long-term bond market, that's been the outperformer. So for the first 7 months, up 2.6%. And then looking at the short end, short-term bonds underperforming, just under a 1% return. Again, not very exciting. And that's the short term is underperformed largely because the Bank of Canada has been raising its overnight policy rate. But I think importantly, for our clients that are invested in the 1 to 5 year investment grade corporate ladder, they've earned around 1.8% so far this year. That is not great, but it's actually higher than the broad Canadian bond market. And in my opinion, we're taking on a lot less risk than the broad market. So in terms of risk, when we look at the long bond market, that has an average maturity of 22 years. That equates to an average duration of 15 years. And duration is just a bond market measure of volatility or risk. So when you have a bond with a 15-year duration, a small 1% increase in interest rates results in a 15% decline in its price. So that's way too risky for our clients. So we're keeping at the short end. We're sticking with the investment grade corporates, 5 years and under, and that sector of the market, the duration is only 3 years.
Okay. Now, previously, we also talked about an inverted yield curve, what that was, what it signaled. Can you give us a little bit of an update on if our curve is still inverted and what that means?
Yeah, today's Canada yield, the Government of Canada bond yield curve is still inverted. And historically, this has been very unusual, but it's been unusual like this for over a year. An upward sloping yield curve is the norm, and that's why it's called a normal yield curve. So we're not within a normal environment right now. So we have a one-year Canada bond yield is around 5.25%. That is anchored by Bank of Canada policy rate of 5%. If we go out to 5 years, the Canada bond yield falls to 4%. Then we go out to 10 years, it's even lower at 3.7%. So the Bank of Canada has no real control over longer term rates, at least not with the conventional tools that it's using today. Medium and long term yields, they're really driven by the bond market and market expectations, not the central bank. So with this inverted yield curve that we have today, the bond market is expecting the Bank of Canada to lower its policy rates sometime next year. And why would they do that? One reason would be to combat a recession. And we have seen that in the past, inverted yield curves have often signaled an oncoming recession. Or they might have to lower rates to fight off very low inflation or deflation. Or they just need to get back to a neutral rate. So a neutral rate, policy rate, would neither be expansionary or contractionary. And the Bank of Canada considers a neutral rate to be around 3 to 4% in nominal terms, or 1 to 2% in real terms after inflation. So when inflation does get back to that target at 2%, today's 5% policy rate would be considered way too restrictive. So when we look at inflation, headline inflation has fallen from around a high of 8% to about 3.2% in Canada. We just saw July's monthly reading yesterday. That was a little hotter than expected, but it really offsets June's cooler than expected reading. And June's core inflation reading was actually negative. And then when we look at producer price indexes, the producer prices, they've been negative for several months. So I think that the last 2 to 3 rate hikes that we've seen from the Bank of Canada have been too aggressive, and they're going to have to be reversed when inflation falls back to that 2% target. And on top of that, another signal that we look at for a possible recession is the corporate credit markets, and we're really not seeing any signal of a recession there. Corporate bond credit spreads in both Canada and U.S. they've been steadily tightening since March, when we had that mini U.S. Regional banking crisis, and right now they're sitting in a pretty normal level historically, and again, not signaling a recession in the corporate credit markets.
Sure. So while we're on the topic of corporate credit, can you talk to us a little bit about corporate bond yields today?
Sure. So the 1 to 5 year investment grade corporate bonds right now, when we're making our purchases, we're getting on average a little over 5% yield to maturity. And that yield to maturity of 5.5%, that's locked in as long as the bonds are held to maturity, regardless of what rates do in the short term. So we have the five-year government of Canada bond yield is only 4%. That's 1.5% lower than the 1-year government of Canada bond yield. So that as we talked, that's a very steep inversion. But it's not the same with corporates. With corporate bonds, the compensation for credit risk increases with the term to maturity. So that additional credit premium that we're getting from extending the term from 1 year to 5 years, it offsets the effects of that inverted yield curve. And additionally, the prices of these corporates that we're getting are well below par. So a large component of that yield to maturity is in the form of capital gains. And a really good example of one of the bonds that we've been buying recently is the TD Bank September 2028. That bond has a 1.9% coupon. We've been buying that bond at 86 cents on the dollar to yield around 5.4%. So 65% of that yield to maturity is in the form of capital gains, which is very tax efficient for our non-registered accounts.
That is fantastic information. Thank you, Nick. If anyone has any questions about today's topic, feel free to reach out to your financial planner or your portfolio manager.